All right, continuing on with our Chapter 2 Excel homework video series. Here we are now on the homework problem number 3. And with this problem, let's see here. So we have a company allocates overhead rate at 150% direct labor cost. So that's our predetermined overhead rate, 150. So we'll multiply whatever our direct labor cost is by 150% or 1.5 to get our allocated overhead. Using the data below, complete the following steps and prepare the entry to close over or under applied overhead to cost of goods sold. So this is a good one where we're actually going to get some practice with what do we do when we have under or over applied cost of goods overhead. And so here's our production cost data. We have actual overhead cost for the current period, $480,000. Actual direct labor cost for the current period, $311,000. And now step 1 is to complete the below predetermined overhead rate analysis to determine the amount of overhead cost to be applied. So the first thing we need to do is just have our 150%. That's the rate that we're using. Total direct labor costs then are right above, so $311,000. And then we just multiply those together to get our total, and this is not really, like when we are doing the job costing, we're going to apply this typically to an individual job. But this problem is just asking us in total, not necessarily by specific job, but in total, how much overhead will we have applied using that 150%. So the answer then is $466,500. And now we want to complete the T account here in step 2 for manufacturing overhead at the right. So this one, actual costs reminder go on the left on the debit side, and applied costs or estimated, this amount we just calculated goes on the right side. So let's go ahead and do that. So this is our estimated amount, and then our actual overhead cost above here, we'll put that on the actual side. Okay, and now if we look at this T account, take the bigger minus the smaller number basically. And so what happens is we end up with a debit balance in manufacturing overhead of $13,500. And then step 3 asks us to determine whether manufacturing overhead is underapplied or overapplied. Type your answer in at the box at right, so right here. And so essentially what we want to, we can kind of think about this here, and I think we can use logic to answer this question most of the time. And so again, our actual cost for $480,000, the estimated cost overhead that we calculated and that we included on our jobs was $466,000. So we incurred more overhead costs than we thought we would, is basically what we're saying, right? So we were under applied because the amount that we applied, this estimated amount, was less than the actual amount. And this is a bad situation to find yourself in. If you over applied overhead and you charged your customers a little bit more, that just gives you more of a buffer to, that's fine as long as the customers are happy to pay it and they're still going to stick with you. Your prices aren't too high. That's good, because it gives you some wiggle room if overhead costs do kind of creep up. But in this situation, we actually estimated too low and didn't, charge customers enough to cover our costs essentially for those jobs. So that could either be a significant problem or it could turn into a problem. So not a huge amount. I mean, $13,500 on $480,000 is not incredibly high, but it's definitely something you'd want to analyze further if you were in the cost managerial or cost accountant doing this work. Okay, step 4, prepare the journal entry to close this amount now to cost of goods sold using the journal entry template below. So when we every time at the end of every accounting period, or usually like at the end of the year, when we get to that point, we don't want to have this $13,500 sitting in manufacturing overhead. We always want to close this out or bring this balance to zero. So if it currently has a debit balance of $13,500, then we're going to credit that account. So I'm going to put the credit in first. And because we want to put something in here to offset this, to zero it, right? So $13,500, I'll just link to it. And then the other account that we always use when we are closing manufacturing overhead variances like this is cost of goods sold, or COGS. Right, and so, our debits equal our credits. And so in essence, what we've kind of done here is just moved this difference to cost of goods sold. And if you remember, cost of goods sold is an expense account. And so us debiting an expense, if you remember dead circle, expense is under the D. So the debit means we're increasing cost of goods sold. So that's kind of makes sense if you step back and think about the whole thing, because basically what we're saying is we underestimated cost of goods sold, or underestimated our cost, essentially from overhead. And so once we realize that at the end of the year, then we'll go, okay, well now we need to increase our cost of goods sold by this amount in order to reflect the fact that we actually had extra overhead costs that we didn't accurately budget for as we were applying overhead throughout the year. So, all right, well, that brings us to the end of problem number 3, and I will see you in the next video for problem number 4.